Hello everyone, welcome to another edition of Skybound Capital's podcast series Under the Macroscope, where we take a look at global economic trends and what a year it has been so far in 2022. It's almost impossible at the moment to predict what the situation might be in the next quarter, let alone the next 6 to 12 months. And joining me on the podcast today are Skybound Capital's chief strategist based in the London office, Jabir Sardharwalla, and research analyst Ross Muller, who's based in the Cape Town office. Gentlemen, good to have you on the podcast again. Jabir, great to catch up with you, and especially in light of your recent presentation on global interest rates. And when I talk about radical change over a relatively short period of time, this must be one macro factor that has surprised even the likes of yourself. I know you've been talking for over 2 years about a rampant inflation cycle, but I wonder if even you could have predicted the change in global interest rates that we've seen in recent times.
Yeah, I think so. I mean, it's the process that we've seen so far is pretty clear. Basically, central bankers, after a period of denial and non-acceptance, have now suddenly got into panic mode. And we even had a warning from the Fed last week. There was an article in the FT that said that now the Fed is really looking to step up on the action and try and get in front of the inflation story. So this week we have the US numbers coming out. I think it's Wednesday. That's going to be a very telling figure. And what I'm looking for most there is actually the core component, because of interest will be the secondary effects of inflation. So that's particularly what they call shelter. So it's the housing side of it. That is red hot right now. It's notorious for lagging the main index by about 12 to 18 months, but now it's truly gained momentum. And I mean, think about this, one of the primary drivers of housing right now, the reason why house prices keep going up, even if there is some moderation of late, is because of the acute shortage of housing supply. So what's it going to take? I mean, if suddenly we go into recession tomorrow, people will still have to live somewhere. And therefore, I don't see rents necessarily coming down sharply. They'll just slow down, perhaps considerably. And on the other side, if growth picks up, and this is now the big story, I think that's well cemented in first half. And we're going to see more of this in the second half, in order to protect those segments of society that are really struggling with living costs. That could mean a whole bunch of, tax concessions in one form or other. Well, if they do boost growth, that's another big boost to rental. So I think we're now in that phase where the secondary effects of inflation are really spooking the central banks. That's the big concern. It's particularly the case in the US. So we shouldn't be surprised that interest rates have gone up. The question is, how much more will they go? And I think that by year end, the Fed funds rate will be at around 3.5% to 4%. So roughly a doubling, a bit more than a doubling from where we are now. I can't see it going up more than that, because otherwise the message it sends to the bond markets is pretty bad. I mean, in sensitivity terms, a 1% rise in the Fed funds rate is another 7-8% off on the 10-year, and even more on the 30. And the 30-year yield is the one that's highly correlated, which it drives the mortgage rates. So it's a real balancing act here. The Fed and others are walking on a tightrope.
We might return to the response of central banks a little bit later in the podcast, but if we can explore in a little more depth for now this recession versus growth theme that you've raised in that first part of the discussion. There's some measures that you used in a recent presentation, manufacturing and service PMIs, and how that reflects where we're at. Perhaps you could expand on that a little bit, Jabir, explain that concept to our listeners and how that indicates where we may be right now and where we may be heading.
Yeah, so basically one way of measuring activity across any economy is through what they call the PMI index, the Purchasing Managers Index. And that's broken into two parts. There's the manufacturing side and the service side. And I think the names pretty much explain which sides of the economy they reflect. Now, those numbers, as long as they are over 50, that means we're in expansion. If they fall below 50, then we're in contraction. And it's quite possible to have an expansion on one and a contraction on the other. But the ideal picture is to have a healthy expansion on both. Now, what's happened lately is that they've both come down. Manufacturing especially has dropped quite a bit. It's now at the low end of 50 something, 51, 52, thereabouts. A month ago, it was 55, 56, that's a big drop. But again, we shouldn't panic over that. I mean, there are reasons to explain why that's happening. And the big driver is inflation, input costs. They are really impacting manufacturers, and they're trying their best to economize around how they produce things. Another factor is that they're struggling to get workers. So there is almost like a natural cap on how much they can produce. So for a manufacturer, there's a balancing act between workers that are available, as well as the input costs, plus the fact that the various raw material inputs needed for production are much harder to get because of very long delivery times. You hear these stories right down. I mean, last week I heard the second story about how somebody has ordered a car and it's already been extended by some considerable period of time because those manufacturers are having problems getting parts. And on the other side, you have the service index. Now, this depends what kind of an economy you are. If you are service reliant, as certainly a lot of mature economies are, hence the name developed economies, then services are going to be a big part. Now, services have been quiet lately. They're opening up again now. And the numbers there are actually still quite comfortable, although they have dropped. But they're in the sort of mid-50s, I would say. So what you've got is nothing that as yet suggests that we're about to enter recession, but the warning lights are flashing because how much more can it take? And the most telling figure that came out was the US Q1 GDP growth rate, where it was negative, which means that if we have another negative quarter, if Q2 is negative, then technically, by the definition of recessions, the US will be in recession. That's 2 back-to-back quarters. But the devil is in the detail. If you look at the data, you'll find that of the components that make up GDP, consumer demand, although it has dropped, is still positive, together with capital investment, which is a good sign as well. I mean, it shows companies are trying to invest and they've got plenty of cash to do it. The detractors, by far and away the largest, was imports. That took a massive chunk out of the GDP number. But there's a logic to it as well, because the dollar is so strong and continues to rise that import costs fall. The cost of importing something is less, and America has a big, big appetite. So there are, that's how to analyze the data, in my opinion. So I could even, if we do this, after the Q2 GDP data by around about October time, I could well be saying to you that even though we've had another negative number, I'm not that concerned, because as long as consumer demand holds up, then it's not all doom and gloom. So the big challenge here is what kind of growth we have. If it's weak growth combined with inflation, then that spells stagflation. If it's weak growth combined with moderating inflation, then you're kind of going into recession. And that's the trick here. That's the whole thing. The constant in this is inflation.
So I have to ask you though, in an environment of rising inflation, rising interest rates, and as you've intimated, although marginally above 50, declining PMIs, what's the effect of all of this on asset prices?
Okay, so if there's no other external support, then obviously asset prices have to fall. They have to fall simply because it's, the asset prices by definition, the formula for it is top line divided by the bottom line. And the top line is growth dependent. Well, if growth is falling, then that's not a good sign. The numerator part of the equation is getting less. And if the bottom part, the denominator, is rising, because that's the, if you like, the risk-free rate, then that's going to have a downward impact on asset prices as well. So all things left alone, if markets were left to run their course just based on that, then it's going to have a detrimental impact, even more so than what we've seen so far. So for the first half of the year, you've got, for instance, the S&P down, give or take 20%. Could it go down even more? Absolutely, if it's left to natural equilibrium. I think the big unknown in this is what more governments do now to prop up their economies. And this is not new. I mean, this has been going on around the globe. Unfortunately, it's only when Western countries actually do something that it gets advertised. But we have seen around the globe measures by all kinds of governments to help take the sting out of the scorpion's tail, the cost of living tail, to help their lowest paid workers. And I think this will go. Now, you've got to think through what the impact of that is on the fiscal deficit. Fiscal deficits are already high as a result of COVID. If those go even higher, then that has to be funded. So how does the government do that? If you take its revenues minus its expenses, and you're left with a negative balance, you're running a huge, budget overdraft, then you can only fund that in one way, and that's by issuing more government bills. And to induce people to buy them, you've got to offer higher rates. So that has an impact on the bond yield market. And typically the 10-year, which is the sacred benchmark across the globe, is your effective measure of the risk-free rate. Well, if that's going up, that's going to have an adverse impact. It's a race against time. So I think what's going to happen is that there's going to be an acceptance that we want to try and temper growth, through consumer demand, but only up to a point, not to the point that you tip the consumer over the edge. And that means falling behind inflation even more. So we're going to have continued inflation, which, as well as its negatives, also has its positives. And the biggest positive is that it erodes debt. And that's the only way I can see us getting out of this mess.
Ross, perhaps I can bring you in here to ask a question. I know we were chatting before the podcast about commodities and in a relatively depressed manufacturing environment, and also in China. We haven't even mentioned China and Hong Kong, which have had these lengthy periods of lockdown in 2022, which has also had its effect on lowering manufacturing globally. But if we can build out of this manufacturing slump, there's a benefit here for commodity producers.
Yeah, Jabir, there was one of my questions to Matt earlier on was, I've been watching the global commodities index and it's pulled back in the last month, roughly 13 or 14%. Is this a sign of the first indicator that we are seeing a slowdown in inflation? That's part one. And then the other part, would be prudent of me to bring in cryptocurrencies into that and the markets of how they've been playing is, are we going to see the commodities and cryptos pull away as well from being, closely correlated in the future due to this interest rate differentials with the two of them?
Okay, so to your first part of the question, Certainly the pullback in commodities of late has largely been due to fears of a recession. So this is a classic case of textbook theory playing out. If you have a recession coming up, then the logic goes that you're going to see a slowdown across, in demand generally. And what do people do on at a household level? They start to cut back. They start to cut back on journeys. They start to cut back on, consumption of various commodity-driven products, and so that has an impact on the commodity spectrum. However, I think again, this is where some degree of psychology comes into play. And by the way, in all of this, I'm leaving aside what's going on in Ukraine. That's the unknown. I have some views on that. I think it's going to get worse, but then we're getting into pure conjecture. So let's just park that. What's going to happen is that we just come out of COVID. Okay, you look at the travel industry, which has clearly shrunk from the supply end. So flight schedules are being cut, petrol prices have gone up, but it's not going to deter the desire amongst people to want to travel. They've just been through a minimum of 1 year of COVID aggravation, and they want to put that behind them. Secondly, they have savings to spend. So any recession won't kick in until they have completely depleted their savings. So I think what's happened is that although there is this belief that a recession is going to kick in, I actually think it's just potentially a good buying opportunity into the commodity spectrum. And I'm not even referring to the energy side, which, by the way, I think will go up again. I do believe that. If you look at the supply and demand of oil right now, even before Russia-Ukraine became an issue, it was very tight. There was actually overall a bit of a deficit out there in the market, which suits oil producers. So they're able to keep those prices high. And around the globe, whether it's shale producers in America, OPEC and non-OPEC, and then right through to Russia and that side of the world, there's no desire to go low or increasing production and therefore lowering prices. This is an opportunity for them to mint money, and that's how they survive. And I don't blame them. I mean, that's how that's how it works. But if you look at the other two components, you've got food. Now, even though food prices fell off last month, the trend is very clear. The FAO gave a clear warning that the trend is upwards. And food is both energy related and weather related. So even if energy remains stagnant from this point onwards, the big mystery is weather. And then last but not least, you have metals and minerals and minings and all of that. At some point, manufacturing is going to gain traction again. When new equipment comes on board, the whole green revolution. Think about the metals and minerals needed for alternative energies. It's massive. I don't think all of this has been factored in. So we shouldn't be surprised. Commodities is a very volatile play, but you have to look at it in terms of trends. And in terms of trends, it's an upward trend as far as I'm concerned. This has legs for a good 3-4 years, if not more. But you've got to be prepared to ride the downs with the ups. To your point about crypto, I mean, I think it's very telling here. So in terms of it has clearly been a risk asset, no question of doubt. What do people expect from a currency? Okay, they expect, it's the usual definitions, right? It's got to be a store of wealth, it's got to be a means of exchange, and all these kinds of things. And whilst it's certainly proving to be a means of exchange, it's not doing anything else. I mean, with the kind of collapses that we've seen in the crypto world, and fundamentally I'm referring to Bitcoin here, together with the other secular issues in the industry, the unwinding, the derivatives play, and I don't understand it. It's you see the headlines. There's a lot of unwinding going on. So I'm very grateful that it never got above 2 trillion. I think it's a lot less than that now. Yeah. And people, if this story plays out, i.e. the economic story plays out in a very troubled and volatile way. I think the world of crypto has, is going to have a rethink. Because suddenly people will flock to the assets where they can store their wealth. And when fiat currency runs out of power, let's say the dollar for whatever reason implodes, and it's not inconceivable. I mean, if rates do go way above expected, and suddenly companies start going bankrupt because defaults go up, they shoot up, then people will want to go back to tried and tested means of exchange, ways of saving their wealth. That's when gold and the like will kick right back in. That's at the moment, gold is just lying there; it's doing nothing. And that's because I don't think there's enough of a mess out there for people to think, oh, I need to get into gold. I don't think that's quite come yet, but it could come later.
Yeah, maybe if I could follow that up with a question relating to your real estate then, because what I've seen in the last year as well is about 20% of the homes in the US were bought up by institutions. And there's some number out there, about 35% of people in America don't own homes as well. Now, the Fed has been pumping in $6 trillion odd into the market. Mm-hmm. Some would say this is the biggest Ponzi scheme of our lifetime. And it's not a word used very lightly. That's why I'd like to get some thoughts on this. Is what is the credible way for the Fed to solve this now?
Right.
We hear this all, but now what can they do?
Yeah. I think it's an interesting point, and you're right. I've heard this as well. They've just being described as a Ponzi scheme. I'm confused on the meaning of the word Ponzi, but I generally take it to be a way of disguising some sort of fraud, as well as trying to prop up something that is should really collapse. I think on both counts, I wouldn't label it as either of those. But definitely the Fed has done its best, and with good reason, to try and support the economy. And they're not alone. I mean, in that case, we're dealing with a worldwide Ponzi scheme everywhere, if that's the case. What they've done is, going back to economic basics, is they've tried to keep interest rates low. They've tried to keep yields low, so asset prices high. And they've done that through QE, basically. And through good old-fashioned QE, they have bought from banks securities, asset-backed securities, and released in exchange cash into the system, in the hope that those banks will then lend it on to those who need it. Unfortunately, and there's no big mystery about it, I don't think QE has been a success at all. All it's done is to benefit the larger companies and to benefit the rich. So in other words, if you've got the balance sheet, you can borrow the money, which means a whole group of entities and people have had to go without. And that's why this other industry, the alternative lending industry, has continued to flourish. Specifically, therefore, to your point about properties, properties has absolutely benefited. It's benefited from several factors, one being the shortage of supply that I mentioned earlier. And it's very, there's an acute shortage. I mean, it's quite scary. I'm really surprised that governments haven't taken action sooner on that. But the other is artificially induce lower rates, which has meant that people can do that famous carry trade, and they can leverage at really dirt cheap rates and go and invest in the likes of property as well as others. And if they can enjoy a growth of between 8 and 12% per annum, even more in some instances, that's fantastic. It's a really nice trade. That's going to unwind, but you made an interesting comment there, the institutions. It's true, the institutions have been coming in and buying up property as well at auctions. And that's one of the dynamics that's changed here. We're getting to a situation where the supply of property stock is going to remain depleted, because whatever's available is just well supported by buyers, and a very different breed of buyers between foreigners, institutions, and and just the general high net worths. So that props up the rental market, and it means that the whole ownership game becomes even more localized. And it's not just the US. We see it here as well in the UK. And it's happening also around other parts of the globe. So it's one of the byproducts. We are seeing a structural shift in the market where, in equities, we talk about the free float, what free float is actually available. And I would argue in the property world, that free float is becoming less and less.
As the old saying goes, time flies when you're having fun. And time has flown on this podcast. But Jabir, I'm afraid I've got one last question. We can't end this podcast at this juncture, given your location as close as it is to Whitehall, to ask you about what is going on in UK politics. The irony was not lost on me that a man who got into office campaigning to leave wanted to do nothing but remain last week, but eventually he was almost forced into resignation. What next at number 10 Downing Street, if you can give us a very quick view?
Yeah. So the consensus seems to be that whilst they were willing to, by they, I mean his cabinet and other advisors, were willing to give him a second chance after his party misdemeanors. What happened more recently, regarding the chief whip, that was one step too far. And so around that, I think people thought in terms of career risk or political risk, not this sort of for the good of the country nonsense. I don't think that was what drove them. So where are we now? Basically, Boris is still there as caretaker, to the point that he's been able to reshuffle his cabinet. He's going to be there for a minimum of 2 months by the looks of it, simply because Parliament doesn't go into recess for another 2 weeks. And then it's unlikely that anything will be done during the recess period. And then the party will come back and vote when Parliament reopens. That's the theory. There is a school of thought that because of the disgust at the fact that Boris is still sitting in number 10, they might just expedite things. So it's expected that 2 weeks from now, they will have whittled down the shortlist, which is currently something like 9 or 10, to just 2 candidates. And the names that are constantly being thrown out are Rishi Sunak and Liz Truss. I don't think it's going to be as crystal clear as that. I think Rishi does stand a good chance of being in there. But the thing that goes against him is the fact that he's very much from that prudent cost-cutting school of thought. Therefore, he wants to rein in spending. And if he does that, he's going to increase the chances of us going into a recession. That's not going to go down well with the public. And the party has to take note. In terms of people that I like, that I think are very impressive, my vote would go to Sajid Javid. I think he's really impressive. He's got a lot of integrity. And there are a couple of others, but beyond that, my list does not go beyond 3. I mean, it's a tough one because I think deep down, nobody wants his job. It's a terrible time to be coming in. They're going to be staring at a potential recession, a summer of discontent, and going into an autumn of discontent, followed by a winter of discontent. So it's an awful job, and I think we're going to miss Boris's charisma.
Well, it's certainly something to keep a very close eye on, and proof, if it was ever needed, that in politics, keep your friends close, your enemies closer, but also in this case, how quickly your friends can become your enemies. We'll have to keep a close watch on that as we go into the autumn and the winter. As always, Jabir, just wonderful to get your insights. Ross, thanks to you as well. And we look forward to having you on the podcast again in the near future. Don't forget that if you want to watch Under the Macroscope, any of the past versions of the podcast, you can download it at www.skyboundcapital.com. All the past editions of the podcast are there. And you can also subscribe to the podcast on Apple and Spotify, as well as the Google podcast platform for Android. So thanks to Jabir, thanks to Ross, thanks to all of you for listening to this extended edition of Under the Macroscope. Until next time, cheerio.